Now, the government co-contribution. This is a classic example of people that are in pastoral roles, that they should actually take advantage of this, because generally their exempt benefits mean that their salary or their taxable income is below $30,000, and therefore they can get maximum benefit here. So the idea of it is that the government brought it in to help low-income earners save for their retirement. The arrangement is that you put $1,000 into your super fund. Now, this is $1,000 of non-concessional contributions, so there's no tax paid on this. There's no 15% contributions tax paid on this money. So it needs to be money that you've received in your hand into your bank account, and then you put it into super afterwards as a non-concessional contribution. It is not salary sacrifice contributions. That doesn't satisfy you for the government co-contribution. And the government will put in up to $1,000 into your super fund. So it's like 100% return with no risk. So it's a small amount, but if you add this up over many years, it is great benefit if you have access to it. Your taxable income should be less than, it's just under $62,000. But if you're under $32,000, you'll get the full $1,000. If your taxable income or your total income is between 32 and 62, then there's a certain amount that you should contribute to get the maximum amount. So I think, for example, if you earn $40,000, it might be like $800 that you would put into your fund, and you would get $800 back from the government. If you put in $1,000 and you were on $40,000 of income, you still would only get $800 back. So you can set it at a specific rate. There's actually a calculator on my website that calculates that specific figure for you. The other requirement is that you need to have 10% or more of your total income must come from eligible employment, running a business, or a combination of both. So that really, and how that's tested a lot is that you need to actually have had some contributions into your super fund. So you need to have some employed income where they've paid some contributions to your super fund to be eligible. You need to be less than 71. You can't be a temporary resident, and you need to lodge a tax return. So what happens is the government, your super fund, so Christian Super, reports to the government, to the tax office, what contributions you've made to super. They then match that with your tax return, and then they say, okay, they're eligible for this co-contribution, and they'll deposit that into your super fund. So a great way to boost your retirement savings if you're eligible year on year. The other one that someone mentioned was earlier on was the the eligible spouse contribution. Now, this is if your spouse earns less than $13,800, but it actually scales back between $10,800 and $13,800. The idea is that you could save $540 in tax by making a contribution to your low-income earning spouse of $3,000. So you put $3,000 into your spouse's account, and if you paid tax that year in your income, then you'll get $540 back from the government. So you're effectively putting in $3,000 into your bank account, into your super fund, but it's only costing you $2,460. So it's another boost if you add them all up. And if you're, say, for example, eligible for the first home savers account as well, you add all those things up, and it's several $1,000s a year that you can boost your retirement savings with. Now, the other one is salary sacrifice. Now, salary sacrifice is, this diagram tries to illustrate what the difference between no salary sacrifice is and salary sacrifice. So generally what happens with your income is that your employer pays you some money into your bank account, but before they do that, or at the same time, they deduct some tax from your pay first. So you get the remainder after the tax has been deducted. And then after the money is in your bank account, then you can spend it on your general spending. You could put it towards your super, or you could save it. In the salary sacrifice scenario, your employer, rather than giving you all that money into your bank account after the tax has been deducted, what they do is that they deduct less tax because you're not getting it in your hand, but they direct it to your super fund and you pay contributions tax. So the benefit of this strategy is, even though you're going to get less money in your bank account and less money to spend or to save outside of super, the benefit of this particular strategy is that you save some tax between the difference of the tax that you would have paid, I guess, up here versus the tax that you'll pay here and here. So generally, if your tax rate is 15% or higher, that is, you earn more than $37,000 a year, then there's a benefit in this scenario because the combination of the contributions tax and the less tax that you pay will be less than the tax that you pay up here where you take the money in your hand. So generally, that's a better case. It's a better scenario to put your super contributions in prior to tax than paying tax on it and then putting it back here. The only scenario where that's different is where you're putting $1,000 government co-contribution money into your super over here. So this is how you need to do it for your government co-contribution if you're eligible for it. But if you're a higher income earner, so you're earning over $62,000, then this is the way that you could get greater benefit. The previous slide was all about describing it graphically, and this is just the full details. So what you're doing is foregoing part of your gross income, and your employer makes your contribution to your super fund instead of getting it into your bank account. Now this is where the numbers work. So this formula here basically represents what I was trying to explain in that diagram. So the benefit of salary sacrificing is the difference between your marginal tax rate plus Medicare levy less the 15% contributions tax times your salary sacrifice amount. So Ben, who's 59 and earns $65,000 taxable income, and salary sacrifices $37,000. I think this was calculated before the tax thresholds increased to $37,000. But the principle now would be if he was earning $67,000, salary sacrifice $30,000. This would be the same scenario. So the benefit is your 30% marginal tax rate plus your Medicare levy less your 15% contributions tax times $30,000. So the benefit annually, so this is year on year, if he did this, would be just under $5,000. If he was earning a higher tax rate, if he was on a higher tax rate, then the benefit would be greater than that because this differential would be more. So if he's earning over $80,000, then it would be greater again, or over $180,000, it'd be greater again. The issue here, as Sue was sort of alluding to, is that if Ben's salary is sacrificing 30% of his income and he needs more than $35,000 to live on, then he can't actually salary sacrifice. So a way around that is to start drawing some money from your pension or from your superannuation, and that's what the transition to retirement strategy is all about. But just showing you an example, this is Joe and Mary, who are aged 55 and 50. They plan to retire at 65 and 60. Joe earns $120,000, Mary $40,000. Joe currently pays tax of nearly $35,000. Mary pays $5,500 in tax, and they need $70,000 living expenditure. If they actually made salary sacrifice contributions, rather than going into the full details, you can go back on this, but they can save. Joe can save nearly $9,500 in tax, and Mary $1,300 in tax. So it's nearly $11,000 in tax in this scenario by salary sacrificing. But what they need to do is be able to afford that. So they need to be actually able to keep on living and have enough funds to live on whilst they're salary sacrificing down to those levels. And this is where the transition to retirement strategy comes into it.